Hey, how you doing? And welcome to Livewire's Buy, Hold, Sell. I'm Selby, and today we're taking a look at 5 companies that have recently announced they'll be slashing their dividends. Is it still worth investing in these stocks? To find out, we're joined by Michael Price from Ausbil and Reece Birtles from Martin Currie. First up today, we have Dexus, which slashed its dividend by 7% at its result in August. It's expected to fall a further 22% in FY25. Not great. Reece, I'll start with you today. Is it a buy, hold or sell?
It's still a sell. We'd say the dividend yield after the cut is about 5%. Interestingly, that is less than the cap rates on the direct property, that the office properties that they can buy or sell. That's very unusual. Normally, the listed office assets are trading cheaper than the unlisted, but the company is having to retain cash and reinvest in the business into lower yielding assets. And it wants to become a fund manager because it's not making a decent return out of its own investments. So for these reasons, we think they're under quite a bit of pressure.
I feel like the market might not have cottoned on all to that. It did fall 9% on the result, but it has recovered since then. Over to you, Michael. Is it a buy, hold or sell?
We'd say it's a hold. So the fact that they did cut their dividend not because of lower earnings, but to reinvest in the funds management business, we see that as at least a better reason than just having earnings going backwards. We do see it as reasonably cheap, sort of a 20% discount to NTA. On the other hand, we don't see much earnings growth for the next year or two. Don't see any real catalyst, certainly not from the bottom up. So while we don't mind holding it, you don't really need to buy it right now.
Okay, next up today we have Helix, which announced it would be slashing its dividend completely at its result in August. Is it a buy, hold or sell?
Helix is also a hold. I think there's a lot of moving parts there. So certainly a disappointing result, and we think there might be one more downgrade to come. On the other hand, we quite like the new management. We do think they can turn things around, and longer term it might be looking better from a bottom-up point of view. If they can sell the imaging business, that should fix the balance sheet, and that's certainly a good thing. But then again, on the other hand, the market has certainly liked that, and the share price has run very hard over the last little while. So I think it looks a little expensive right now, and with perhaps another downgrade to come, no need to buy it right now, but the longer term prospects are okay, so hold.
As you mentioned there, it has been on a run recently. Its share price has lifted around 13% since announcing its result. Reece, over to you. Is it a buy, hold or sell?
For us, this is a sell. The question is it cyclical decline or structural? And we think this is structural. The company has made very poor capital allocation decisions over time. They paid too much for the business, and so they've underinvested in it over a long period of time. It's caused them to have to go down market into commodity type testing, which has put more and more pressure on their margins. And now they're selling their best asset to try and fix the balance sheet. And we don't really believe that the governance and the management team really have the right experience for this business. So it's a sell.
Okay, last up today we have Pilbara Minerals, which also announced it will be slashing its dividend completely. Last one for you today, is it a buy, hold or sell?
It's a buy. I don't think you're going to get any dividends for quite a period of time, so it's not about buying the dividend, but the lithium price is at very low levels at this point. At least a third of world production is unprofitable. So I'd think of it more of as a value or value type stock, but we do think as more and more production is shut off, the lithium price can improve, and Pilbara does have a good business going forward.
Off the back of the result, all the major brokers lowered their targets on Pilbara Minerals. The stock has fallen around 22% since then. Last one for you today, Michael. Is it a buy, hold or sell?
Yeah, I'd agree. I think it is also a buy. Look, they slashed their dividend in order to protect the balance sheet, but the balance sheet's still reasonably strong. There's no risks there. Yeah, we're comfortable with the longer term outlook for the lithium price as the unprofitable supply comes out of the market, and we think there will be strong demand for lithium, for batteries, electrification, decarbonisation. And as Reece said, they've got great assets, so one of the best lithium assets in the world. So might take a little while to get there, but happy to buy it here.
Okay, we've asked our fundies to bring along a stock that has slashed its dividend, but they still think it's a buy. It's a little bit of a challenge for our guest today. Michael, what have you brought for us?
I've gone with BHP. Yes, it has had to cut its dividend on the back of a lower iron ore price, but it is very committed to paying out at least 50% of its profits into dividends. And they've certainly indicated that in terms of longer term growth, they really see dividends as a priority. They know they're valued by Australian investors. They're happy to increase their debt levels rather than cut their dividends to fund longer term growth. So that's a good thing from an income point of view. I know people think of BHP as pretty much just a China play, but we think it's exposed quite nicely to the longer term secular trends. Again, decarbonisation, electrification, even data centres, AI all need an electricity grid that needs lots of steel and iron ore, and they need lots and lots of copper. And BHP has some of the best copper assets in the world. So yeah, put all that together and happy to buy BHP here.
Okay, over to you, Reece. What stock are you buying today, even though it slashed its dividend?
Yep, so I've definitely come with a high risk, high reward one for you, which is Fletcher Building. So it's cut its dividend to zero. It's seen to be under quite a bit of stress, but we really think it's about the cycle primarily in New Zealand, where they've had a lot more impact from higher rates. The economy has been under a lot more stress in terms of construction. They're ending some of their construction projects that have been difficult, and they have a strong land bank that we think that they can monetise value to protect the balance sheet. It's not going to pay any dividends in a while, but we think it's an undervalued stock on the back of those dividend cuts.
Okay, well, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube and podcast channels. We're adding so much great content just like this every single week.